Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What's the weather like for your portfolio? Will it withstand tropical cyclones or founder in the shoals of harsh reality? Joining me today in his waterproof sou'wester to talk about his all-weather model portfolio is Rudi Filapek-Vandyck. G'day, Rudi.
Well, thanks for granting me the opportunity.
Now, Rudi is the editor of FN Arena Investing Newsletter and the mind behind the FN Arena Vested Equities All-Weather Model Portfolio. And Rudi had a recent article, 10 years of the all-weather model portfolio, where he reflected on the standout performers, key lessons learnt, and the strategies that have shaped his approach to investing in quality growth stocks. Is that a fair summation?
Yeah, I think so. I think maybe the best background for listeners who are not familiar with what I do is I'm old enough to remember the GFC, the Grand Financial Crisis, and for many people that's obviously a long time into the distance when the dinosaurs roamed the earth and all of that. But at that point in time, my curiosity was awoken by the fact that some share prices didn't seem to fall, while others went down by 70, 80% and more. And from that experience, I dedicated my research in finding the better quality companies in the share market. And there are a few lessons to be learned from that. And that's obviously why I sometimes reflect back on the decade past and things like that, because we were all ingrained in our brain as investors that the best way to invest in the share market is you buy beaten down share prices, and that's just the watertight way to superior investment returns. And every time I look back over my shoulder, and in this case the past 10 years, that statement that is obviously that's being put to the test and basically been proven wrong. The companies I select for my research and also in the portfolio are usually companies that are highly valued. They trade on much higher multiples than the average in the market. They're usually described as being expensive. And yet, if you look back, they outperform the market, and not just by nose length, they outperform the market by multiples. And one of probably the best example to quote here is one of my favorites, Technology One. I basically had to order some champagne bottles this week because it marked my first 10 bagger in the portfolio. And for those who don't know what that means that the share price has appreciated by 1,000% over the past 10 years. The share market itself has done a little bit over, let's call it 46% each without dividends, and 120, 130-ish including dividends. So the return over the past decade has been larger from dividends than it has been from share price appreciation on average, or at the index level, I should say. So you can see how the outperformance from a very strong performer like Technology One has been in comparison to basically the majority of the market. It's absolutely stunning. It's phenomenal. And the irony is that a lot of people will argue now, yeah, but that stock is just way too popular. It's way too expensive, so to speak. Admittedly, 10 years ago, it wasn't on the same multiples as today, but it was expensive, between quotation marks, 10 years ago. And the irony on top of that is that me being a happy shareholder, I wake up every morning with a smile on my face because I do have Technology One in my portfolio, and I still do not intend to sell it. So maybe these things should make a few people, at the very least, pay attention and rethink their strategies in the market, and maybe they should investigate why companies like a Technology One, and obviously all the other ones that I follow closely, why they are such great performers, irrespective of the fact that they They are not trading on very low multiples, and they don't start off from very low multiples. And obviously, they have that little bit of extra.
So you're completely destroying the narrative of value investing here, aren't you? And this is something that I've noticed so many times when you go into a filter of stocks available, based on various metrics, and you look at this. Here's a great company. Here's a great company. Here's a great company, but they're trading on these huge multiples, and you think. You kind of get scared about investing in them, but often they are trading at those large multiples for a reason, aren't they?
Yes, exactly. And and you're right. I mean, I'm probably the one who often makes a little bit fun out of your typical dyed-in-the-wool value investor, because they think that you can possibly not buy these stocks that I own in portfolio, and it's a religion in the share market that you have to have.
they've been listening to Warren Buffett. They've been listening to Warren Buffett too much, haven't they?
Well, no. Here's the irony, and it's funny that you bring up Warren Buffett, because I'm not necessarily anti Warren Buffett. To the contrary, but one of the jokes, and that's an observation that stands, that I often make, is you see thousands of people, also from Australia, they travel to the US each year. And in the past, they want to see Charlie Munger and Warren Buffett for hours, two old guys sitting on stage and talk. So they really idolize those guys. And then they go home and then they buy stocks that those two guys would not even look at, even if they were drunk to the gills. And that's the irony, is that Warren Buffett would never, ever buy stocks that so-called value investors in the local market get stuck with. I mean, the Horizon Holdings, the Heliuses, the Lendleases, and etc. They wouldn't give those stocks 5 seconds of their time. Yet everyone who idolizes Warren Buffett thinks they're doing the right thing by jumping on those stocks. The other observation to add, of course, and that also links in with the observation I just expressed, but also with my own research, is that while value investing worked pre-GFC for prolonged times, as we had normal cycles and we had very strong cycles also because of China for commodity stocks, we haven't had those cycles after the GFC, in basically not anymore since 2015-ish. And then obviously the question is whether this is now a permanent phase where we no longer have a share market, no longer have a global economy that is equal to what we had in the 60s, 70s, 80s, and 90s, or whether we are going through something different. And on my observation, most value investors, they keep on relying on research that harks back 100 years, 50 years, 40 years. But that research, of course, it doesn't apply in the past 15 years. It hasn't worked, all those things. And that's, if I can draw a longer bow, the reason why you now have fund managers like a Perpetual and a Platinum, while they are in trouble and they can't basically, unable to beat the market on active management, is I think they are still investing as if this is the 1970s. And it isn't. And that's why they get stuck with Helios and they get stuck with Horizon Holdings and the likes. And those who own Technology One, REA Group, Resmed, CSL, Car Group, and the likes, Wisetack, Xero, you name it, they have no problems in outperforming the share market and treating their investors with handsome returns year in, year out. And that, of course, is the challenge now for those who think that sitting on undervalued assets is the right way to go still. I mean, there are plenty of challenges. I'm not by any means promoting that we should all become momentum followers, because a lot of those stocks that I just mentioned, they are carried by positive momentum, and that's maybe one thing that needs to be emphasized as well. I'm not a shareholder in Wisetack today because the shares have had positive momentum for the past 2 or 3 years. mean, I was there well before that. I mean, I'm just lucky in some cases that the stocks I own, that they are being picked up by the broader market and ultimately end up in a positive momentum trail. Having said so, I also believe that sometimes you need to make your own luck in the share market. And one of the reasons I firmly believe, one of the reasons why the past 15 years is different from the decades before that, is that we are going through this tremendous technological changes in society. And in my earlier research, I already have gone back to the 1920s. And that's the period where I compared this period with. The normal recipe of investing is that a company only has a limited amount of time when it's going through a sharp acceleration in growth. It usually stops after a while. Either competition kicks in, or the economy changes, etc., etc., etc. That's why value investing works, because famous quote by Buffett: "You never pay up for growth." But that is not true when you go through this tremendous technological changes, because those companies who enjoy the tailwinds of the technology, they can go for years on end, and it keeps on going. Right? And this is also why, for example, stocks like a Promedicus and a Xero and a WiseTech, having already grown really, really fast for years on end, they are nowhere near still the end of their trajectory. It can be, of course. I mean, some of those companies, they come unstuck. I mean, for a while, for example, A2 Milk growing very, very strongly. And then that story came to an end. We had Ramsay Healthcare for a while, doing very, very well. And that story has now also come unstuck. So some companies still come unstuck in their growth path. But there are plenty of companies out there that can do this for a decade and longer. I mean, I remember coming to Australia, and in those days, I mean, those companies were smaller, but they were already in those days known for fast growing trajectories, the likes of Cochlear and ResMed and Aristocrat in those days as well. Now, if you fast forward 2 decades later, those companies are still growing very fast. They're still trading on high multiples, and they've treated their shareholders really, really well over those 2 decades. And again, with the exception of Cochlear, which currently is not in my portfolio, the likes of ResMed and Aristocrat are in my portfolio, and I still intend to hold them for the next 5 to 10 years, because I still believe that they can still achieve strong growth above average, without the cyclicality that you will find in 80%, 90% of the share market, essentially. So yes, I think my research and my approach, I think it puts things a little bit on its head, and it's not necessarily that you want to buy everything that's expensive, but I think at the very least, investors need to understand that in many, many cases, a cheap-looking stock is cheap for a reason, and not always. I mean, stocks obviously can look expensive for all the wrong reasons, but there are examples out there, plenty of them, of companies that trade on above average multiples, and they deserve to trade on above average multiples not because they are expensive, but because they will deliver for many, many years on end, and that for that reason they cannot be cheaply priced. That would be a contradictio in terminis, as they said once upon a time in the Roman Empire.
What was that? Was that Latin phrase?
Yeah, that was the one. Yeah, conditio. Yes.
Well, there's always circumstances as well, and they can put all of us on the wrong footing. Sorry, there were just so many questions that I had going through my head then. And it was funny because I was going to mention one of those fund managers, one of those value fund managers that always talk about their story and how they've done it. Yeah. So what do you think has fundamentally changed to investing? I mean, you're kind of referring to that things have changed. Is it just technology that's changed it, or something else underlying?
Yes, well, there is a combination of. Before we go there, let me make one thing clear as well.
Please take over the interview, Rudi.
There you go. There's always room for value investing. Yeah, there always will be, and that is because the share market never loses its stripes. The share market will always derate companies out of fashion too far, so they are too cheaply priced, and it will always push popular momentum stocks too far, at least temporarily. So there's always, but I think you have to be really, really a specialist as a fund manager, and there's only a limited number of those who can do that successfully, and they will do a good job at it. But for all others, and that includes you and me, we're more we're more normal humans. We are very bad in this context in value investing, and there's a couple of reasons for that. One reason is technology is definitely very important. I sometimes wonder what the share market would look like without AI and some of the other technologies that have taken over in recent years. But there's also the fact that we are going through a period where central bankers inject way more liquidity in the system as we are adjusted to in the past. That has, without any doubt, that has had an impact on asset prices, on share markets, etc. The other thing also is that with the economic cycle, whether that now has completely disappeared or at the very least, I think we're seeing different cycles. They are different from the past. If anything, they seem to be more shallow and shorter. And that makes it in itself makes it very difficult for cyclical businesses to really, really generate a lot of value for their shareholders. But before they know it, the cycle is already turning, which makes it for them really, really difficult. In a time when you had long, elongated cycles, in the 70s, for example, it was like the likes of BHP and Rio and Orica and you name it. It was much easier for them to have long, elongated periods of very strong profits, very strong dividends for shareholders as well, and therefore share prices that would perform for a very long time. What I've noticed over the past 2 decades is the cycle comes in, it's very sharp, it's very brief, and you breathe 2 times and it's over. And those shares are again out of favor. And obviously with results that a lot of people are losing money in those sectors. The other thing also, which is I don't think is enough emphasized, and people don't realize this enough, is that businesses itself have changed dramatically. And in a very simplistic format, is that corporate profits are much higher these days. Moats around businesses are almost impenetrable. Look a bit double tongue. And what we also see is that where old businesses used to have a lot of capital locked in buildings, in machinery, you name it, modern day businesses are what they call capital light. And that also means that the margins can be extraordinary. And so I have learned to appreciate the fact that a lot of data that people are relying on these days, like the valuations of companies generally, the profit margins, etc. I mean, 5, 6, 7 years ago, that used to scare the bejesus out of people because people go, oh, historically, there's never been this high. So basically, the implication is always is that the market is running on fumes and share markets have to come down. But and they still come around those charts and those tables. But what those people have to realize, and luckily over the years, what you see is that more and more people are realizing this. That's not an indication that share markets are constantly in a bubble. That's an indication that the economy and businesses are changing, and financial markets are changing with the economies and with the businesses. So that's the reason, for example, why U.S. equities now trading on historic multiples at historically high profit margins are not necessarily going to come crashing down next month or by the end of the year or in early next year. As a matter of fact, the majority of people who follow the US market, they're almost convinced that the market in 12 months' time will be higher than where it is today. And that is because you cannot simply rely on numbers that you draw out from 100 years ago and compare today's markets with markets back then. And I think also, luckily or not, the research I started in 2008 really was done at the right time, I should say. I sort of preceded the early stages of all those changes happening, but it definitely has helped me to understand that there's more to the share market than apparently cheap and expensive, because cheap is often cheap for a reason, and expensive is often not as expensive as it looks like. And that's because, of course, there's another quote from Warren Buffett I can throw in here, is that he basically has said in the past that there is no difference between growth investing and value investing, because both elements are joined at the hip. And that's exactly what I think, what he understands as well, is that a company on high multiples is only expensive if the growth that is assumed is not coming through. If that growth comes through, the share price is not expensive at all.
Are we ready to talk about the all-weather portfolio?
Is that where we started?
Well, no, I thought the plan was to talk about the all-weather portfolio, then
That's
to
true.
talk about the general philosophy. But no, we do love a bit of general philosophy on the podcast. Okay, so let's get back to it. But how did you initially put together the all-weather model portfolio?
Yes. So in 2008. I started my research, and I got really curious, like why do the majority of stocks fall by so much, and you have this selection of stocks that doesn't seem to be impacted as much, and that led me eventually to identifying that basically some companies are of a higher quality than others. And that's not simply the CEO or the board who sit there. It's usually the type of the business. I mean, I'm not a scholar of Buffett and Munger, but I do pick up some of their quotes because there's a lot of value in there. And one of the quotes I often use is, I rather invest in a business that can be led by an idiot, because sooner or later it will be led by an idiot. And basically that's the type of business I like to identify. I mean, it's almost not that important who's at the helm. It's just a great business, irrespective of what happens to interest rates, to what happens to the economic cycle, and a business that can perform under all circumstances, or under most circumstances, I should say, because those businesses, they do exist. They can be identified. I've done it myself. I'm not the only one. There are other people doing it as well. But when you identify those high quality businesses, you realize a couple of things. One is that you can almost never get them cheaply, because if they get cheaply priced, that's probably a sign that something is wrong somewhere. And that would be for example, that would be the obvious mistake to make in jumping on Ramsay Healthcare when the share price was derating, on Domino's Pizza, for example. That's a story that also came unraveling. And you can also mention the likes of A2 Milk and the like. So while they are expensive, irony, they are good to have in portfolio because they perform. As they become cheaper, they probably not the ones you should probably say goodbye to them, because they will only become cheaper and cheaper, and the share price goes at some point goes really, really low. But the experience I have, and my research obviously suggested that you should not be afraid to own stocks like an REA Group. And I mean, I have an anecdote of REA. I mean, I remember when it was around $60. And just about everyone said, like, oh, it's so expensive. It's like it's overpriced, you name it. Look at where the share price is today. And that's basically what those companies signify, is that they can look very expensive in the short term. But another example, for example, is Pro Medicus. Right? People people have been saying that you can't possibly buy that one at $70, at $100, at $200, at $300, but it just keeps on going. And it doesn't mean that story can't become unstuck at some point. It can, but it also means that what looks expensive is not by definition not that expensive, and it all depends on what comes next. Now, while you can argue that a company like Promedicus comes from nothing, that's a relatively easy way to become successful. But what you see with companies like REA Group, Car Group, ResMed, Cochlear, and others is that they can do it for a decade. They can do it for a second decade. They can probably do it for a third decade. So clearly, it's a combination of the business itself. It clearly has a lead on the competition, and a lead that can be defended and not that easily broken down by the competition. But it also has to be in the right sector. And that's also something I've come to appreciate over time. In the first 10, 15 years or so of my research, two of the companies that were in there were Brambles and Emcor as well. And they've performed well for prolonged time. But if you follow them long enough, you also come to realize that their customer base can be quite cyclical. And ultimately, those companies cannot escape the fact that their customers can be quite cyclical. So that breaks down a little bit of the quality label that you can attach to those companies. They become more cyclical in the worst of times. But that's basically the long and the short of it. So you identify companies that are head and shoulders above the competition. And they obviously, you hope that they're being led by a great management team. And they have to be in a sector that in itself grows. And that's often the mistake that people make as well. A high quality company led by high quality management, but in a sector that is in decline, unfortunately, there's only so much they can do unless they're superhuman. That's maybe one of the things I don't really believe in that CEOs can be superhuman. So I know that everyone has his own definitions of quality, and I often have a big smile on my face when I hear other people talking about the quality companies they own, and then I look at the companies and I go like, yeah, right, that's gonna last. But the companies I selected back in the first 10 years after the GFC, they have largely remained intact. A few have disappeared off the list, like the likes of Seek, for example. And again, sometimes a company has an excellent 10 years, maybe an excellent 20 years, but then sometimes the growth story, it stops at some point. And then you simply have to acknowledge that. I was lucky enough in 2014 that we already have quite a number of years in my research that I was approached and by people who said, how about we put that research in a portfolio? And that's why that was 10 years ago. And I've learned a lot, because there's a difference between doing research and selecting companies and talking about it, but then actually managing a portfolio. Yeah, that's a little bit of a higher degree, and that I still learn a lot from that. And 10 years later, of course, it has also meant that I'm even more convinced that there's a lot of value to be had in selecting high quality companies. What I often notice also, because of the angle I have in my investing, is that too many people are led by the share price. It's almost there is this saying in the market that everything has a price. I completely disagree with that. And I mean, you offer me a nice turd on a plate, and even if it's 10 cents in a dollar, I will not buy it. But for some people, of course, it's a different style of investing. We also have to realize that a lot of people in the share market, they just jump on and off in stocks. And of course, you can always do that, but that's not the style of investing that I've been employing with the portfolio. I'm definitely a buy and hold investor, Buy and hold is by no means dead or out of fashion or whatever. You just have to pick the right stocks, and you have to remain confident. And it doesn't mean that sometimes I skim some of the top, and sometimes I increase exposure or buy extra shares. You do all these things, of course, but buy and hold is when you have the right portfolio and the right stocks in portfolio is definitely something that is for people who not necessarily want to have all the adrenaline while they look at their portfolio. I like quiet and gentle and just things going along instead of having to jump on and off all the time.
The Riviera approach to investing.
Yes, with a glass of wine or a glass of beer and a nice
right.
pasta.
ShareSite is the portfolio tracking and reporting tool that takes the hassle out of managing your investments. Here's how it works. Import your trading history with just a few clicks, either from your broker, from a spreadsheet, or manually. ShareSite organises all your investments in one place, no matter where the assets live, so that you can track your total performance. Go to the link in the description below and get 4 months free with the Shares for Beginners exclusive offer. Market prices, currency movements and corporate actions such as dividends and share splits are automatically recorded going back up to 20 years and ongoing to keep your portfolio up to date. Simply email your trade confirmations to ShareSite, or better still, get your broker to do it. ShareSite automatically updates trades in your portfolio, so there's no data entry required. ShareSite gives you a 360-degree view of your portfolio, with capital gains, dividends and currency fluctuations. I'm flummoxed as to how I ever managed my portfolio before ShareSite. It's easy to compare individual investments, identify non-performers and get an accurate picture of your total return. Believe me, it's changed my investing forever. And ShareSite's detailed tax reports makes your accountant's job easy. And we know that a happy accountant is a happy accountant, although you'll be saving hundreds or even thousands of dollars in fees, so maybe they won't be so happy. You can access ShareSite from anywhere, and because it's protected by bank-level security, you can get peace of mind knowing your data is always backed up and secure. So throw that spreadsheet away and get started now. Go to the link in the description below and get 4 months free with the Shares for Beginners exclusive offer.
So from what I've seen in the article, and we'll put a link to the article, can we publish the article in the blog post as well, just so the listeners know that what we're talking about, get some more detail about
why not? Why not?
Or with
exactly.
a portfolio?
Yeah.
Okay, so it seems like there were like 2 remarkable stocks. There was Technology One, who you referred to, and Aristocrat Leisure. Then there were kind of middling ones, and these are quite good, high quality, as we say, high quality names on the share market that just basically didn't do very well. And there's some dogs. Just run us through a little bit some of the stars and the middling, and
I think I have to correct. I think I have to correct you here. What when you say there's 2 stars and the other ones were middling one, we have to realize that we're doing this from the portfolio's perspective. So from the market's perspective, the large majority of the stocks have all outperformed the market by multiples. Yeah? Like stocks that, for example, that you've just described as the middling one, they still did middling one. They still did 4 times the share market over 10 years. 4 times, not 4% more or 40% more. 4 times, a multiple. Which is significant outperformance. Yeah? It's just that I would not necessarily have chosen Aristocrat and Technology One as so far ahead of the rest, but they have both completely. The other thing also is Xero actually has performed even better than those 2. It's just that I didn't have Xero in portfolio in the early days. They came later. But it just means that if you manage to pick the right stock, I mean, one of the stocks that just to show you that what I told earlier about trends and about technology coming into the market stuff. One of the early buys I added to the portfolio is NextDC, and I still have up until today a lot of people who are very, very wary going anywhere near that stock because A, they don't understand it, B, it's not profitable, it has a lot of debt, and you name it. But it's that too is about understanding the company's business and understanding why that is. Why is NextDC loaded up with debt, and why doesn't it report a profit, etc., etc.? And that is not comparing it to your normal technology business. I mean, it's essentially an infrastructure play, an emerging infrastructure play. And if you realize that it's a quality business, it's being led by management that knows what they're doing, and they're carried by a mega trend. I mean, just look at how life is changing even in the past few years. I mean, the amount of data we're all using, it's explosive. If you look at what lies ahead of us, self-driving cars, more and more cloud usage, anything from your mobile phones to your laptops, you name it. I mean, the usage of data and what the likes of Google, Apple, and everything, what they store about our behavior online, that you just realize that there will be a need for companies like NextDC, and if they do the right thing, their growth should be explosive as well. And that's exactly what has transpired. And I know people look at me and think like, Rudi, he's very good. He picked Technology One. But I'm actually more proud of myself that I picked NextDC when it was a young, emerging listing on the stock exchange, about to be added to the ASX 200. And I've owned it all this time through the D ratings and the upswings and the D ratings again and the upswings again. And again, it's one of those stocks, I believe, that's probably going to double at the very least in the years ahead from the current share price. And the current share price is already 4 times higher than when I started buying it. So when we say all the other stocks outside of Aristocrat and Technology One, I mean, if you look at the likes of Hub24, WiseTech, Xero, I'm sure I'm forgetting a few. They've all done really, really well. And when people ask me like, how do you time your buying and things? I mean, in practice, I find it's more a case of human psychology. And someone like myself, I don't like to sell when everyone is selling. Because I'm so like, for my feeling, I think I'm just adding to the selling pressure, and also it doesn't seem to be the smartest thing to do when everyone is running around without the head firmly screwed on their shoulders, and then you're gonna sell some shares. But
I'm glad that you consider yourself a market whale that can affect the share price.
I wasn't saying that, and I definitely don't want to be owning any of those stocks where I am moving the market. But I'm also the person who doesn't want to buy when everyone else is buying. I mean, that doesn't seem to be the smartest thing to do either. But so when most of those, maybe apart from the very early beginnings of the portfolio, but most of the stocks I've bought and those companies I just mentioned, I usually buy them on the pullback, and that's also and again, there's a human psychology factor to that as well. You want to feel good about yourself that you bought them on the dip or when they were selling off. And if you look at share prices, for example, the Hub24s, the WiseTech Globals, the Xeros, you go back over the past 10 years or so, there have been times when those shares would go down by, 20% or so. I mean, easily. And clearly, every single occasion, they were buying opportunities. Instead of having the attitude as an investor to go like, see, I knew it, they were expensive in the first place. No, the attitude should have been like, finally, I get my chance. And that's obviously what I've done with the portfolio. Now, I do realize that while we're talking about all the successes and the ways of doing this, there have been failures. And there definitely have been failures. And I'm never afraid to talk about them as well, because we should all learn from them, including myself. And I've already mentioned a few. The Ramsay Healthcare was previously in my portfolio, previous in my research, and then sometimes you just have to realize that sometimes that story ends, right? And even if you're a bit slow in taking that on board, you don't have to be there in the full D-rating all the way to the bottom. I mean, you can sell at some point, and that's basically what I've done as well.
Rudy, if I can just interrupt on that point.
Yes.
I mean, you regretted selling Primedicus too early.
Yeah, definitely.
But then what's the difference, and how do you identify the difference between a Primedicus that'll come back, pull back and keep going further, as opposed to a ResMed where something, not ResMed, it wasn't ResMed, what was the one that you just said?
Ramsay Healthcare.
Ramsay Healthcare, that's
Ramsay,
right. Yeah, that was in some sort of structural decline.
Yeah, that's an easy one. So, and that's a very important lesson for me as well. I sold Promedicus because I got a little bit discomforted by the fact that my portfolio consists of high multiple stocks, predominantly, and the bond market was gonna smash all of them, which the bond market truly did, and I expected some of the stocks to fall further than they actually did. So I sold stocks like Promedicus, and then they recovered much quicker than I anticipated. And as I earlier said, then you get the human factor, and then you just don't get aboard, basically. In hindsight, early in the year when Trump his shenanigans were pushing the share market into a downspin. I should have jumped on Promedicus back then. Golden chance, too slow, attention elsewhere, whatever you name it. Missed chance, definitely missed opportunity. So the mistakes I've made over the years, most of them, is more based on the fact that I temporarily believe the stock is probably getting a little bit hot on the collar here, and I can probably buy it back cheaper later. And that's in some cases not the case. And then obviously you regret it. I mean, that's just simple. The market plays around with your mind, and you made the wrong decision. You assumed that the market would pare it back, and it didn't. The difference with a Ramsay Healthcare, and there have been some other examples as well, is that you come to the realization that story basically is looking differently. And the same as with MCOR, for example. That's when you realize that those golden years we've had, they look a lot less golden, basically. Do I always make that decision? No. One of the biggest mistakes I've made in a few years is that I was a happy shareholder in IDP Education. I took some money off, then it started generating bad news. I kept a small proportion in the portfolio, not much, but just enough to still be on board and expecting that if that story turns around, I can buy more shares. The good thing is I did not average down in the share price, and I did not throw more money at it simply because the share price was cheaper. I think that's a very flawed investment strategy and philosophy. That's a good thing I did. The not so good thing is I kept on holding on to the shares, thinking that surely this is the bottom in the bad news and it's going to turn around because it's a good company and all of that. I completely underestimated that the political landscape has turned against immigration. And that basically affects student numbers internationally, and it basically, for the time being, has had a massive impact on IDP. Even though it is most likely the better operator in that sector, and that also brings me back to what I said earlier. CEOs are human. A very good business turns into a much less good business when the sector itself is in decline, and obviously they couldn't stop it. Now I've sold out. I've missed this last leg down. That's a good thing. Even though, of course, it was a small part in the portfolio only, it's still still stings a bit. But I mean, I need to learn lessons from that, just like anyone else. I mean, you can't just hope for the better. I should have sold out earlier and read the signs. And again, it's done by humans. We all make mistakes. But that's essentially the long and the short of it. There's two stocks. There's probably three stocks currently I have in portfolio, which one would say objectively they haven't performed now for a while. One is Dicker Data, another one is Woolworths, and then there's CSL as well. I don't think any of the three will end up my next IDP allocation. I truly believe that's not the case. Sentiment in the market can be extremely important in the short term. I think sentiment to all three of them is very negative and has been for a while. But I do think underlying those businesses will get back on track, and that's basically an assessment you have to make. And sometimes, unfortunately, your timing is off, or things happen. Like for example, in CSL's case, who would have known that they put an anti-vaxxer in charge of the administration in the US, which clearly increases the risk profile of that, and that's why the share price is moving. I mean, there's a logic there, but I still haven't seen a strong reason why I should say goodbye to a share price that's arguably undervalued here. But those are the assessments you make, and one of the things I do as well is I can see the difference with a lot of people who are in the share market and they're retail investors, and they only have, I don't know, maybe 5, 6, 7 stocks and then they are so focused that each stock has to perform under all circumstances at all times, because they have no patience and they get scared. Having a portfolio, my portfolio approximately has 22 items in there. I'm also for example, I'm a firm believer of having some gold always in the portfolio, which also is the case. So that's why I say items and not necessarily shares. But when you have 20 investments in portfolio, you tend to look, and maybe there's sometimes a little bit of weakness as well in the case of IDP education, but you tend to look at it as a football team. And as long as you're winning games, yes, maybe your defender on the right hasn't really played his best game in the last 6 games or so, but you believe that as a team you keep winning, and he'll get it right. I mean, that's how you see the portfolio as well. And so you can withstand the fact that 1/3 of your portfolio, or maybe even more at some stages, is not really shooting the lights out. But your portfolio as a whole is doing well, and that also gives you reason to get up with a smile in the morning. But it should, with little mistakes that creep in, at the same time, you have to keep on paying attention to your garden, of course. And if there's some weeds in there, sometimes you have to act.
Well, this is the second episode in the row that we've had a football analogy. And when I say football, it involves a foot and a ball. And we know what we're talking about here.
You mean what we Europeans call football?
Wogball, as we call in Australia.
Yes. Well, I think you're not allowed to say that anymore.
I'm half Italian. I'm sure I can say that. I'm sure that Sushi Mango have used that term once or twice, so I'm still going to use it. So listeners who want to find out more, I mean, I'm a big user of X, and I think you're a big user of X, formerly known as Twitter. People can follow you there as well, because you've got you lead some quite robust discussions there sometimes, don't you?
Well, yes, you could say that. I mean, someone like myself who sometimes dares to question the logic of buying cheap price stocks and dares to question why you should say goodbye to the likes of the stocks I just mentioned. That often irks people, and it often attracts a lot of criticism and everything in between, I should say. But by all means, I mean, I'm on X, previous Twitter. We, as FN Arena, of course, we have a website. We are a web-based business. People can find us there. We are on Facebook with the business. I'm on LinkedIn. And we might here and there add a few more things on social media also. We are a relatively small player in the market. We realize that we will never be the Microsoft of the Australian finance. But then again, just like some of those technology companies we have on the stock market, you can still do very, very well by carving out your niche. And I think we've done that very well, I think, with FN Arena. We've carved out our niche, and we relish in what we do. And luckily we have an X amount of people that think that's worth paying for and paying attention to.
Okay, well, good luck to your team. I hope the football team keeps on scoring consistently, but not too aggressively. Thanks very much for joining me today. It's been great speaking again, Rudi. We'll do it again soon.
Okie dokie.